Welcome back. Well, we've been telling you it's going to be a subdued start. Anuj joins us as well in the studio. Hi, Anuj. Morning. It's going to be a bit of a down day, it seems, to start off. But what's your sense? It's weekly expiry as well, so things will, will get a little volatile in the second half.
Absolutely. The header of my chat is the names bond, right? It's the bond yields, which has clearly impacted all the moves. But I'll tell you one thing, Nigel. Of course, there's a bit of a fear factor, but our market had presaged that yesterday in the last hour, especially the currency market, the way it had moved, almost like a mid-cap stock yesterday. So some part of this is factored in. It's not as if the market's woken up to something which is, almost extraordinary. So let's see how things move. Normally on days like today, I have a simple theory that, the SGX Nifty low becomes your first level to watch. And if that holds, then the market can actually attempt a rally. So the low was 17,340 on the Nifty, and 17,350 in any case is a very strong support. So let's see. My sense is that there will be some algo trades on the long side, and 17,350 to 250 is a big support zone. This is where perhaps the bigger traders would try to buy the dip if you get a dip around this zone with 17,250 as stop. If 17,250 is breached, then maybe exiting long positions would be the logical move. I think the index should track today's Bank Nifty because there would be perhaps a bit of a algo trade which will play out in the morning, which is to perhaps maybe buy IT and sell banks because of the currency factor. But if the Bank Nifty, it's still the strongest index. If it does not break some crucial levels, 39,500. 39,500 is where the rally began actually. So 39,500 would be a good entry opportunity if you get it. Access numbers today though, so that's going to be interesting. And of course you have Kotak and ICICI on Saturday. So 52% of Bank Nifty reacting to numbers. But my sense is that, given the recent evidence, there will be smart money which will try to buy the first dip. If there's a second dip which sort of breaks the first dip, then that's a different issue. But 17,340, 50 thereabout, my sense is there would be some buying.
Okay, Anuj, thanks a lot for that. And since you spoke about the big banks coming out with their numbers, right? Even this morning, it's been stellar, the kind of performance we've seen from the banking space. IndusInd Bank in pre-opening is up almost about 4%. Very good numbers coming in there. AU Small Finance Bank had a good showing this time around as well. Max Financial from the financial space. Max Financial also, the VNB margins looking good. By the way, the rupee opening once again at 83.01. So we'll track the rupee very closely for you. But what are the stocks that you need to trade today? Mitesh and Kush are still with us. Kush, take us through your list. What would you buy and sell?
Sure, two stocks, both on the buy side. The first one is Kalyan Jewellers. Now, the stock has been doing fairly well for a very long time. But what's interesting is that in the last couple of sessions, the volumes have picked up. And despite the strong run-up, the volumes are picking up, the stocks, going higher. The stock took a bit of a breather yesterday, but, that's all right. After such a big rally, a small breather is absolutely warranted. So Kalyan Jewellers remains a buy for a target of 115 and a stop loss of 100. My second pick is KEI Industries. The stock had done fairly well, and along with the market, it saw a dip. 1400 and 1450 is where the stock made a very strong base and has now begun its rally again. The volumes are also fairly strong on this one. I would say the recent swing highs of 1600 would be your first target, and the stop loss would be 1480.
All right, Kush, thanks for that. Mitesh, what about you in terms of stocks you'd want to trade?
Yeah. Prashant, I have a mix of buys and sells, so 2 buys and 2 sells. On the buying side is Concord, which had a very strong move yesterday. So on a mild dip, let's say 7-8 points, around 763, 764, buy at the stop below 749 for targets of 800. Infosys is a buy around 1475, 1477 zone. So another 0.5% lower opening could be a good entry point here. Keep a stop at 1457, look for targets of 1515. And on the sell side are a couple of IT names. LTTS has had a breakdown yesterday. That's a sell with a stop at 35.26 for targets below 3400. And FSL is a sell with a stop at 104.5 for targets of 97.
Okay, all right. Well, thanks a lot for that. Mitesh, have a good one. That's the pre-opening rate settled marginally low, about 45 points lower. Gurmeet Chadda is still with us. Gurmeet, it's a slew of banking earnings that we're heading into, especially over the weekend. You have ICICI Bank. Any of them that you would buy ahead of the numbers? Because it's been a really strong showing so far for the ones that have come out.
Yeah, so I think gradual accumulation probably is the correct way to go about in markets like this. As Anuj said, with 4% kind of bond yields, you will be always under pressure because, on one side and with recession fears, the interest rate cycle will reverse 6 months, 12 months, whatever time period, we can debate on that, which means that there could be high single digit returns there as well. Our own 3-year bonds are now trading at 7.6, 7.7%. So you have to keep doing that trade-off, and I think you're better off with banks vis-a-vis the NBFCs because there will be a liability war with bank credit credit growth being very high. I think ICICI continues to be structurally there. I mean, we continue to accumulate that. I think amongst the smaller ones, we are looking at Idfc now. The CASA mix has improved to almost 50%. The legacy book is down. The infra book is just down to 4%. I was seeing their bulk cost legacy borrowings because that's that side we usually don't track. Next 2-3 years, the high cost legacy borrowing at 9% would be replaced by, on an average, maybe 5-6% cost. That will also add to the NII and bottom line. Retail advances, they are doing very well, almost 30% CAGR. Still remains at about a little more than one book value, much more reasonable. So if they can manage few stress accounts without taking names right now, I think the bank could be up for a re-rating.
All right, Gurmeet, thank you very much. I mean, that's another point, right? That yields and fixed income instruments at 7.5%, 8%. That's, competitive. Yeah, it's not been an issue at all. We talk about TINA, right? There is no alternative. But 8% fixed assured on things like, even HDFC instruments or safe instruments, high quality, that's got to count. At some point down the line.
All right. Prashant, I believe it's a big day, though, in your household today. It's a birthday party, I believe. Is it?
Really? I didn't get any invite.
Prashant's wife's birthday.
Oh.
So, not looking at deposits, looking at the expenditure, I think, today.
How much are gold prices, by the way, now?
Prashant knows.
No gold, guys. No gold.
Dhanteras is coming up, by the way. It's a big day in the Nair household.
Thanks for the helpful reminders.
On national television, there's some gold coming through. All right.
All right. So that's, what's going on. All right. DCM Shriram reported numbers, and they posted a tepid kind of second quarter, led by a weakness in the vinyl and sugar businesses. The company has seen profits slip by 20%. Operating margins have also contracted sharply to 11% compared to 15% last year. Amit Agarwal, ED and CFO at the company, joins us. Amit, good to have you with us here. Thank you very much. So just start with the vinyl business. I think last quarter also you had indicated that because of the slowdown in China and they being, I guess, more export oriented, that's a segment which is suffering. Can you talk to us a little bit about what's happened in the quarter? I think there is a EBIT loss. What's the outlook there in that business?
Yeah, thanks for having me on the show. See, the business which has got significantly impacted is the vinyl business. That's largely driven by the global factors, and because there is a demand slowdown, given that the construction globally is coming down, given the recession fears, and coming from higher interest rates and things like that. So that's there to stay. But there's also a positive side to it. What happens is when the PVC production is down or capacity utilization is down, which means that the key input to that, which is chlorine, there also the capacity utilizations in the chlorine producing plants is low, which means caustic output is lower. And therefore caustic prices for us remain supported. So we are also into, we are one of the largest caustic suppliers in the country, manufacturers in the country, and that supports our prices.
Okay, so what do you see as the way forward in terms of, all the businesses? Just trying to understand, do you think that you could perhaps head to even single-digit margins because of the pressures that we're seeing? You're currently at about 11%, but just a ballpark number that you expect for the full year?
See, for the full year, for company as a whole, the margins should be in the range of 14 to 15%.
Okay.
Because if you see, except decline in PVC, the chemicals business, the caustic soda chlorine, that business is stable. Slight dip in margins. Last quarter, we had 35% EBITDA margin. This quarter, we had 30% EBITDA margin. And I expect these margins to be around that levels, at least for next quarter. And if you see all the other businesses, whether it is Farm Solutions, Fenesta, Fertilizer, all the businesses have done well. So therefore, I really don't see any significant pressure. On top of that, the sugar business, which, because of its seasonality, it will see better performance in the coming 2 quarters. And therefore, the margins have to come up in the rest of the year.
Actually, that was my follow-up question for you, because the sugar business is still loss-making, right? There's an EBIT loss of 15 crores. So when you say better performance, are you expecting to turn into the black in this fiscal itself? Because you're putting some capex on board as well.
Yeah. So see, because as I said, because of seasonality, when the production starts in the coming quarter, the business will turn into the black in the next quarter itself. So that's very clear. The reason why there were losses in the current quarter, one, there were one-time impact because of certain circulars which got issued by the government, wherein we had to take almost 15 crores one-time impact, right? So that's point number one. Second, in the last season, there were higher cane costs and certain other consumables were higher, because of which the sugar cost was higher, which could not be fully compensated by the output prices, which also went up but could not fully compensate. Now, going forward, the profits will increase. Secondly, as I said, and as I always feel, as a company, the way we feel that we need to invest in growing volumes. And that's what we are doing, whether it is sugar business, whether it is chemicals business, we are investing in growing volumes, whether it is existing businesses, or it is new lines of business, or it is circular economy, innovation, sustainability. That's what DCM Shriram stands for today, and it will stand for in the future.
All right.
That's what we're investing about 3,500, 3,600 crores to drive our volumes over the next 1.5 years.
Very quickly, Amit, we are bracing for market opening, but your second half of the year, you'll have to do margins of around 16-17% to get to that average of around 14-15%.
Yes.
So we'll hold you at that, because of the first half of the year, it's been in the early teens, 12-13% odd.
Sure.
Amit, what about the top line growth? If you could give us, what is for the business, what is it likely to be? And you just briefly mentioned that about that capex of around 3,000 crores. So how much of this will be funded by debt? What will be your peak debt level? Very quickly.
Answering your first point, our revenue should be in line with what we've seen in the first half of the year, right? And in terms of my debt levels, by end of the year, I'm expecting my debt level to be in the range of around 1,700 crores, plus minus 100 or 200 crores here and there. And because the capexes will complete by Q1 of next year. So therefore, there will be some amount of debt coming in next year as well. But that's the kind of debt levels I'm seeing.
All right. Thanks a lot for stopping by and speaking to CNBC-TV18. That's DCM Shriram. Under pressure, down 6.5%. The market, by the way, is indicating a fall of 90 points at opening. ITC is the only stock, ITC, that's holding up ahead of its numbers, because numbers are expected to be good. Other than that, all Nifty stocks are in the red. So let's get some calls in at 9:10 this morning. What's the big call to watch? Mitesh is here with us. Mitesh, what are you looking at?
I'll attempt a long here, Sonia, suggesting to buy Concord around 763, 760 zone with a stop below 748, 749 and a target of 800 to begin with.
Okay, that's on Concord. Thanks for that. Well, IndusInd Bank reported a very strong set of numbers. Abhishek is here to tell us more about that. Abhishek.
Well, records galore at IndusInd Bank in terms of its performance. So, on 8 quarters in a row, both YOY and quarter-on-quarter, they have been seeing operating profit growth. The net interest margin has come in at 9-quarter high of 4.24%. The return ratios, both the ROA and ROE, are perhaps the best in last 11 quarters, with ROA of 1.8% and ROE around 14.5%. So, YOY and quarter-on-quarter, the loan growth is perhaps the best that you are seeing in last 2 to 3 years. Slippages ratio, that has also come down to about 2.5%, perhaps the lowest that you are seeing in last 8 quarters, and second lowest that you are seeing in last 12 quarters. So gross NPA ratio has also declined to 2.11%. This compares to 2.35% in the previous quarter, and the gross NPA ratio is at 14-quarter low. So both in terms of NI and PAT, they have beaten our poll on account of strong performance. Back to you.
You called it, Abhishek. Thanks so much for joining in and giving us that quick update. Well, I'm looking at the aluminium stocks, Hindalco, Nalco, Vedanta as well. Alcoa came out with its set of numbers. It was down 5%. In post-market, it's down another 8%. Revenues were down by close to around 8%, but the profitability did contract by close to around 70%. They reported a loss, but that's because they had a one-time restructuring cost. The reason for the miss was that aluminium as well as alumina prices, both of them were weak. Energy costs continue to remain elevated. Raw material costs as well have spiked up. And as I mentioned, that restructuring cost as well. The guidance they've lowered as well. For the aluminium business, they're maintaining it. But on alumina as well as on bauxite, they've lowered it by a little bit. So keep an eye out on these aluminium stocks. We also have the dollar index that strengthened, which is normally negative for base metals. So expect these stocks to be under some pressure. But Sonia, you're talking about two-wheelers?
Oh, very interesting note from Citi. They have a pair trade. They are recommending to buy Eicher and sell TVS. And that's interesting, right? Because the TVS has been one of the stronger stocks. But here's their reason to buy Eicher Motors. They're saying new models could definitely boost Royal Enfield volumes. The high operating leverage could boost the margins, and Eicher Motors is relatively insulated from the EV transition, and the stock has underperformed TVS by almost 40% year to date in this calendar year. The reasons to sell TVS Motor are potential headwinds to TVS Motors volumes because of weakness in exports, enhanced competitive intensity in the domestic motorcycle segment, and at 10%, TVS EBITDA margins could perhaps be peaking, is what Citi says, and the stock trades at a comparable premium to its own 5-year average as well. So that's an interesting pair trade there.
Oh, absolutely. And, we'll keep an eye on both these as trade starts. We're just waiting for the market opening, and we'll have the first rates up on the screen in just a bit from now. The pre-open has left us with a 90-odd point cut, so this is much better than what the picture was on SGX an hour ago, maybe a little over an hour ago. Of course, it's basically an eye on the rupee, an eye on the market here in terms of what's happening. But so far, I mean, the rupee has already, of course, been trading for about 14-15 minutes. There is not very much by way of pressure. Sonia.
Okay, so that's the first stick that you have on the index. The Nifty is down about 72 odd points, 74 points lower now. The Sensex is down about 229 odd points, and the Bank Nifty is indicating a cut of 220 points. So not a good opening for the market. What's dragging? IndusInd Bank, interesting, maybe a sell-on rally over there. 4% lower on IndusInd Bank now, despite a good set of numbers. You have a Hindalco, JSW Steel, the entire metal pack is facing some heat. All auto stocks are perhaps seeing profit-taking. Eicher Motors, Bajaj, Tata Motors are all in the red. And then you have something like an Ultratech Cement that's down almost about 1% Divi's Labs, HDFC and Bajaj Finserv that's also trading in the red right now. But it's peculiar, IndusInd Bank, despite good set of earnings, maybe profit-taking over there. On the upside, ITC expected to be a good set of numbers, strong volume growth this time. The stock in any case at a 52-week high, so up about 0.2% there. Cipla and BPCL are a couple of other names that are just holding on the green line, and Axis Bank as well, flitting between red and green. Otherwise, it's a weak opening, no two ways about that. The advanced decline ratio is also firmly in favor of the declines by about 1,300 stocks. And it's, the rate sensitives, there's banks, there's autos, that's under a bit of pressure. But how are the mid-caps?
Well, Sonia, DCM Shriram, we just spoke to the management. Well, the stock is open up with a cut of closer around 5%. Metro Brands, Mangalam told us that, that acquisition that they made, it looks pretty good. And that stock is open up in the green, so that one's bucking the trend. Suzlon, today's the last day to subscribe to that rights issue if you want to. So yesterday the stock was up close to 20%. Today as well, it's seen some bit of follow-through buying. On the flip side, a few stocks that are under pressure, just pull up AU Small Finance Bank. The stock is getting clobbered. It's down closer around 6%. Havells has pulled back closer around 3%. The margins coming in at around 8%. That's the lowest we've seen in the last 10 years or so. So that one's clearly taken a knock. Naveen Fluorine as well has pulled back a little bit. And Persistent Systems, the numbers look good. Remember, on the top line, the growth was better than expected. Margins were a little bit better, but that stock as well has seen some profit taking, starting on the back foot just to kickstart trade. A couple of these aluminum producers, as we pointed out, Nalco, Hindalco, both of them under some pressure. So a fairly subdued start, but nothing that we were not expecting because the SGX Nifty kept us well prepared. We're opened up lower and we're holding at around at 17,430, Prashant.
It's quite remarkable, Nigel, because 45 out of 50 Nifty stocks are in the red and the market is down just 70 points. But, those 5 stocks which are higher include names like Reliance, ITC, HUL, and there is Nestle as well. Asian Paints is up as well. But Reliance is kind of flitting between red and green. Reliance, of course, is a big one. You can pull it up, a big weighted name. And if that holds, I mean, that can provide a little bit of support. Broader markets, straight away, 2:1, declines to advances ratio. So this is a sort of lower start. The recent listing from earlier on Monday, Electronics Mart, that is starting, 4% lower. That's the first red it's seeing after coming to the market. So that's EMIL. IndusInd is still down 4%. Naveen Fluorine is down 2%. On volumes, Havells is another one which is down 3%. Reported numbers yesterday. There is Tata Motors, which is down about 1.25%. AU Bank is down 5%. I think we mentioned that earlier. Container Corporation was a big gainer yesterday. That is down about 1.25%. And you've got Hindalco, which is down about 2.25%. Persistent, Varun Beverage are some of the other names which are starting in the red at this point in time. So it's not a bad-looking screen. We've got about a 75-odd point cut coming through right now, 17,441. We've got our market master of the day. Sridhar Shivaram is investment director at Enam Holdings, and he's joining us on the program from our studios. Sridhar, great to have you with us here.
Thanks for
Season's
inviting me.
greetings, and great that you could make it to the studio.
Yes, happy Diwali to everybody in the studio and also to all the viewers.
Thanks very much. So how are things looking to you, Sridhar? I mean, is there a broader challenge, a slight challenge to the market from here on? Is it looking a little challenging?
It does. I mean, our view for 22 broadly had been and has been, it is also right now that 22 is a tough year. As it is looking, we may actually, even the first half of 23 also may be slightly tough, not because of more of India reasons. More, I think the global challenges are still there. I mean, you got the UK inflation number at double digit, US inflation still at 8%. We have geopolitical tensions now, even with the China chip issue, which is, you know, a lot of people are writing about, where US has sanctioned, you know, a lot of trade-related issues may come up post the China elections. So we don't know how things are shaping up. Who thought a conservative UK pension fund will have a leverage? I mean, what all comes out, we don't know. And looks like these institutions never learn, even after 2007. So I think these are times to tread very carefully. India is looking good within the overall, you know, emerging markets and developed markets. But does that mean that, you know, we can escape some of the global shocks if they come? So that's how we are positioned. We are cautious, but we know that things are looking good as we enter 23, possibly for India at least. But how it shapes up, only time will tell.
Okay, well, for now, you know, something very interesting in the market. Despite good numbers, a lot of stocks are selling off. So there's IndusInd Bank, there is Persistent Systems, there's Home First. Decent set of numbers from all fronts, but 3-4% losses is what you're seeing on the screen. So some profit taking perhaps. Sridhar, good morning. Happy Diwali to you,
Happy
your
Diwali.
team, your family.
Thank you very much.
You said tread carefully.
Yes.
What does this mean for an average investor who's watching you right now? Has the time come to take your money out, to sit on cash, or do you think that this will just be a painful time-wise correction and your portfolio may not see too much damage?
So I would say for a retail investor, the SIP, which I think the Indian mutual fund industry has done a great job of marketing. I mean, that's how you should be, because markets are volatile. So you just stay with an SIP, you get the benefit of, you know, lows and ups of the market. As far as institutional investors are concerned, that's where all this, you know, happens, where we try to position. So as far as we are concerned, we do have higher cash than what we have normally, knowing that we could get some opportunities as we go down, maybe in the next 1 or 2 months, or maybe in the first quarter of next year. And if we get interesting opportunities on the way, we would like to, you know, use the cash and, you know, buy for the next 3-4 years. India does look good. I mean, things are falling in place for India. But it doesn't mean that we can just buy anything without an eye on how the earnings is looking at. That's how I would say.
Hi, Sridhar. Thanks so much for coming down to the
Nigel,
studio as well. You know, as you said, sitting on some ammunition will be good, right?
Sure.
When the battlefield opens out, you have your money, you can allocate and buy the best stocks.
Yes.
What about IT? Now, I recall the last time we chatted, you were relatively underweight.
Yes.
And you pointed out that it's a myth that Indian rupee is weakening. You can't just say it's positive for IT companies.
yeah.
Has your view changed a little
No.
bit? We have had a lot of commentary that's come in there. And the street is split down the middle. Some believe that in the longer term it'll do well. But you don't believe the time has yet come?
So at least my personal view, it hasn't changed. I think the worst will come. So if you look at IT industry, the first half is normally much better than the second half. You normally hear terms like furloughs, you know, holidays and stuff like that, which impacts the IT industry in the second half. We're already seeing slowdown as far as hiring is concerned, as far as IT industry is concerned. I think the worst for the IT industry will be possibly the third and the fourth quarter.
Okay.
Maybe stocks will bottom out then. To say that, you know, all the negative news is priced in, as we are seeing even with this results, that good results are also not getting priced in. So we don't know. It depends on how the overall market is at that point of time. My feel is possibly the fourth quarter is when I would start re-looking at it, because I'll have more information. I'll have some sense on what's happening in terms of the demand. But if US is entering a recession, Europe is entering a recession, they're going to have a muted growth. And then you can, you know, weigh your, you know, pluses and minuses and see how it is positioned. At this stage, I haven't changed my mind. I would still be underweight.
Got it.
Is there an earnings challenge, Sridhar, for the overall market? I mean, FY24 earnings were at one point pegged at 1,000 rupees, and now it's closer to 900. And there are still downgrades coming as we go through this earnings season. What's your sense?
I think there is. I mean, it's now reasonably sure or clear that it's a K-shaped recovery. As we were discussing, some brokerages have put overweight on a premium bike company versus another. But that's what we are seeing on the ground, that anything which is premium, I mean, they're selling like no tomorrow, even from a footwear to, a retail mall, which is on a high street versus, somebody who's in a B or a C town. We are seeing a stark difference in terms of, the spending power. So obviously, we are going to see this where some companies will do much better. A larger part of the market is, addressing the masses, which will have a challenge. So I would say export-facing companies will have some challenge because demand will be slow. So I think there's a lot of uncertainties. I think earnings will be down. But having said that, there are enough pockets where you're seeing, as I mentioned, if there's a K-shaped recovery, there's a whole upper part of the K where there is enough opportunities and more. So that's how we are trying to position our portfolio. It is challenging, but I think there are opportunities. That's how I'll put it.
What about telecom? The data has been pretty good. I mean, Reliance Jio, in fact, has added the most number of subscribers for the 5th month in a row. Bharti has been doing really well. Is this a space that you see more opportunity?
So we are very bullish on telecom. So if you go back, I would say 5 years, the industry revenues were about 2 lakh crores. After 5 years, we have come back. We went to almost 1,50,000 crore industry revenue. We're back to almost 2 lakh crores again. And we think that the ARPU benefits from here straight goes into EBITDA and profitability. And we are just 2.5 industry players now. I think this segment looks very interesting. I mean, 170 rupees ARPU, they are absurd because the amount of data usage from what we are getting today to what we were, say, 5 years back, all sorts of freebies thrown in. I think easily you can see a 200 odd ARPU or even higher over a period of time, and that benefits the EBITDA straight away. So I would say that, I mean, that's the segment we are very bullish on.
Is data mass or premium? I'm just wondering.
No, data is mass. Data is very much mass. So, I mean, at the pricing that
will you have pricing power there? Which is the bet?
So the question is that today telecom has become part of roti kapda makan.
Correct.
It is an essential. It is not a discretionary anymore. So if there is a discretion between a shampoo and a data pack or a soap versus a data pack, I think the Indian retailer is very clear, the individual at, say, even a remote village, that it is data over shampoo or soaps. So to that extent, this is part of essential. So what we are talking of is an increase in ARPU of, say, 50 rupees or 30 rupees a month. And even that, the industry has struggled for 5 years. But I think industry struggled because there was a new player and he wanted market share.
Yeah.
But as sanity prevails, we will see that ARPUs can easily go up from here, and that benefits the industry. I mean, that's our call. Time will tell whether we are right or wrong. That's how we have positioned ourselves.
Sridhar, I as well listened to Sonia's updates on all these two-wheelers and the auto space. For me personally, it's been very difficult to sell any Royal Enfield vehicle that I've owned. The 350cc, the 500cc, I came this morning on the 650cc. That's
why are you selling them? I'm part of the same gang. I ride them. I'm so happy with them.
Sridhar, for me, affordability becomes an issue, right? I can't keep all of them. I need to pick and choose. So just go up on the CC and hold on to that one. But that aside, what about the auto space? How much of the good news is already in the price? And which pocket of the auto segment do you still believe there is value? Two-wheelers, there is some bit of struggle, I think so, on ground. When you talk to Bajaj Auto, whenever the management joins in. But CV, people are very, very bullish. What's your take?
Yeah, so very similar to that. I think there is, the EV-related threat is more to the two-wheeler, especially at the entry level or slightly at the mid-level of the two-wheelers. We're also seeing a lot of these, electric, I would say not moped, but not scooter, somewhere in between, all over Bandra. I understand it's all over, Bangalore and Delhi also, which people are using. Which mostly the delivery boys are using today. But whatever it is disrupting some usage in some form or the other. I think the two-wheeler space is poised for EV disruption to start with.
Yes.
So that, I think, just the threat that it could get disrupted, their valuations do come down.
Okay.
But as far as CVs are concerned, we think as the economy is recovering, we track a lot of toll data of toll companies which are listed. They're showing very encouraging toll numbers, which is suggesting that the traffic movement is very strong. So we think that the CV cycle is poised for very interesting growth from here on. Passenger vehicle also is looking good because there is a premiumization angle there which is doing well. So that's how I'll be placed as far as auto is concerned.
You know, talking about EVs, right? The global headline is, of course, Tesla's numbers that they posted. The numbers were not too great, but they've guided for a 50% growth in this calendar year.
Yes.
Of course, it's in the passenger vehicle EV space, but I take your point about two-wheeler EVs that could sort of blow out going forward. But one final word, since it is Diwali.
So EVs are blowing out, I think.
They shouldn't be used together. I said blow out, I didn't say blow up. But take that point. It's Diwali, and every Diwali, of course, it's the typical question that we ask people who join in. What's your Diwali pick?
So Sonia, there's no Diwali pick. It's not like a day and I suddenly decide, okay, this is what I want. But if you ask me, one pick or one sector, I mean, this is what I said even last time when I was here 2 months back, that the financial packs look extremely good. I mean, banks, just buy any of the large banks who have an ability to raise CASA, and you can just sit on them for 3 years. The outlook is looking so good. Look at the credit cost. Even when you speak to them, they'll tell you that the credit cost, what they are, penciling in when they are, building in the risk models, the actual numbers are, at least 20-30% lower than that. Initial phase of rate hike cycle, the banks tend to benefit because assets gets repriced before the liabilities. Even there, if you see 190 basis points of rate hike, banks have hardly increased 50-60 basis points as far as liability is concerned. Whichever way I see, I mean, the stars are aligned. You don't need to, pick and choose, or you don't need to time them. Just stay put, just stay invested in financials or a financial-oriented mutual fund, or buy whatever you can. I think things are looking very good for the next 3 years.
Just a slightly contrarian view. I spoke with Kenneth and Rade recently, who doesn't own any financials. But having said that, his point of view is that are we, because the mass segment is hurting a little bit, is not doing very well, right? Who are banks lending to? I mean, where is all this credit growth coming from? The premium end, the rich, so maybe there is some borrowing, but bulk of the borrowing, the need is at the lower end, right? So for banks, does it raise sort of quality issues down the road, not now, maybe 6 months down the line?
So I think when you ask me this question, I'll be very cautious on the MFI segment, which is really at the bottom of the pyramid and which is totally unsecured, where I take your point. At the slightly middle and upper middle, there seems to be like there is enough buoyancy happening there. I mean, that's showing up in the numbers. Even I was skeptical, say 2 months back, because things were even worse 2 months back, so or 2 quarters back, and look at the numbers how they are playing out. So that's how I would say that there is some merit to the fact that there is some buoyancy in the economy which is showing up in the middle level. At the extreme bottom level, it's not showing up. So which is the K-shape we spoke about.
That we're talking about. All right. Thank you very much, Sridhar.
Thanks a lot for inviting me.
Happy Diwali once again.
Thanks a lot. Happy Diwali to all of you and to the viewers. Thank you very much.
Thanks very much. I mean, the market is doing absolutely, not absolutely fine, but I should say just fine, given all that has been thrown its way with the currency market volatility, with global cues being down, Asia being down. Look at a market like Hang Seng, for example, down 4%. And here you got hardly a 0.5% cut. So 17,439 is what we have at this point in time. Guys.
All right. Let's move on then, and let's welcome our first guest. Let's chat with the management of CG Power. They posted a rather good set of numbers. The revenue was higher. The margins came in at around 15%, and that was the surprise out there. The company has also decided to expand their motors facility at Ahmednagar as well as at Goa. And for that, they have outlined close to 230 crores odd. But let's focus on the margins first up. And we have Mr. Natarajan Srinivasan, the MD of CG Power, who joins us. Hi, Mr. Srinivasan. Thanks so much for joining in. Well, this 15% margin, is it an aberration? And what should be the steady state? Because the price cuts, I understand you haven't yet taken, and that could come in the coming months. So what is the steady state of margins that you should be working with? You could give us for the consolidated business or even EBIT margins for both your two segments. Go ahead.
One is margins looks extremely higher when you compare to the margin for the corresponding quarter of previous year. previous year, probably it was the worst. That was the time when the margins were very low because of the high commodity prices. So therefore, the comparison actually giving some kind of a distorted results. As you rightly said, going forward, some of the cost benefits on account of the material prices will have to be passed on. We are for this quarter, I think, compared to the previous quarter, the margin increase has been around 4.5 to 4.6%. Maybe I think, probably, while I cannot put a number, at least about 2 percentage point may have to be prepared for over a period of time.
So 13%, 13% margins, that's a sustainable number?
So I see, because, still the stability, price stability has to come in commodity prices. They are still been yo-yo is there. And in our case, apart from commodity prices, we have been effecting some procurement efficiencies. We would, we can say that we would try to reach that number, 13, 13.5.
Okay, 13.5%. So this quarter's margins are on the higher side, but that's not the average that you'll see for the full year. Got that. Tell us a little bit about the demand situation, sir, especially at the opportunity from the Indian Railways for electrification, signaling systems, upgrades. Any new orders, and what is the visibility on the order book that CG Power has at the moment?
So actually, we have in the press release, we have given the executed order book as of 30th September. This stands at about 3,600 crores compared to 2,750 crores a year ago. Of which this 1,750 crores is industrial and 1,900 crores is actually the power systems. Inquiries are very strong in power systems. Railways, actually, as I mentioned earlier, generally this is a tender-driven business. They float tenders 1 year in advance. So for the next year, probably the tenders will be decided in the next 2 quarters or before March. I generally feel that the order book continues to be good.
Okay, so what does this mean for your overall growth? I mean, in FY22, of course, you had a low base, but it's a growth of almost 85% that you saw in your earnings. You're sitting on a base of around 5,560 crores. But I guess, that's not comparable because you had COVID as well. But in FY23, what would a sustainable growth rate be on the top line?
So for the 6 months ended, if you see for the half year, I think we have grown the top line by about 36%, and then PBT is about by 91%. So generally, the second half should be better than the first half, or at least definitely will not be lower than the first half. I will leave it like that.
Okay, all right. So for the year, sir, since you've already grown by 35%, should we pencil in something like a 20-25% growth at least? That's one part. And also, exports is a very small part of your business. You could correct me on the number, but I think it's only around 10%. Any slowdown you have seen on the export side of business?
So exports were never targeted beyond that because domestic demand is very strong.
Right.
So I mentioned earlier also, we don't want to do exports at the cost of sacrificing market share in domestic market.
Right. And what about growth? Growth,
what the numbers you mentioned can be maintained, definitely.
20-25% for the year, or you want to say 25% since you've already done 35%?
Yeah, sure.
Okay, so I guess the reason why Nigel is also probing is because, you've done some debottlenecking, right, in the motor segment. And that last time around you told us that will add about 10 to 15% to your capacity. Once that debottlenecking gets done, what do you think the incremental or the compounded growth could be over the next couple of years?
So it is possible to grow the overall for the company as a whole, minimum 20% top line for the next 2 to 3 years, to the extent there is visibility.
Okay.
Okay. All right. Mr. Srinivasan, the other point that the street is looking at is the new production development, new products, whether you're looking at HVDC equipment or higher kV JIC. Could you tell us, as a percentage of your total sales mix, how much is the focus currently on this new business, the new product business? And also, going ahead, do you see this scaling up?
So new business actually in the area of motor business, if you look at, whatever we supply, start supplying to EV or whatever we're positioning for the EV segment, that will be entirely new business. it's considering the overall demand that is expected to come from EV as well as the export, plus some of the inquiries from MNCs for sourcing from India because of the China. We have decided to put this a capex of about 230 crores for increasing capacity, which will take care of all these new as well as the existing products. It will be difficult for me to quantify in terms of percentage terms because these production facilities will be fungible. So different type of motors can be manufactured, including for the EV segment.
Okay. So this 20% top line growth that you're looking at in the next 2 to 3 years, this is the domestic business, right? I mean, because you said that not too much of it, you don't have a very high growth potential in exports. So I'm guessing this 20% growth is purely domestic?
Partly, substantially domestic, and then, if there are some MNC sourcing, etc., that will be taken as out exports because it will be supplies outside India. Maybe that would be about, maybe we are targeting about 10 to 15% over the next 3 years' time.
Okay, all right, we'll leave it at that. Mr. Srinivasan, always a pleasure. Thanks a lot for joining in. That's CG Power. They're saying that the second half should be better than the first half. And overall, they're looking at a 20% compounded to growth in the top line over the next 2 to 3 years. By the way, the market, it's cut its losses in the Nifty, but the mid-cap index is under quite a bit of pressure. So don't lose sight of that. The index is down 300 points right now, the mid-cap index, and it's almost 1% gone there. Lots of stocks. Piramal Pharma is not, it's down about 5%. AU Small Finance Bank is down. Indusyn, Ashok Leyland, Samvardhan Motherson. A lot of non-index large caps are seeing selling pressure. RBL, Canara Bank, all under pressure right now. We'll step into a quick break. When we come back, we'll have the management of KPIT, Kishore Patil, to discuss their Q2 earnings. We'll also speak with Prestige Group's Chairman and Managing Director Irfan Razak to discuss the business update, which is very good for Q2. More on that in a bit. Stay tuned.